AI has a major problem. Perhaps you heard of it. It's power. Data centers operating AI equipment alone is expected to be just about the same as India, a country with about 1.5 billion people. And there's one company that we're going to look at that's found some success in providing power for artificial intelligence use cases. We last pointed it out like 50% ago, but they, GE, Vernova, just reported earnings. We're up like 15% today, and it's not from what you might think. Yes, revenues have been slowly creeping up. 8 billion, 9.1 billion, 10 billion, 11 billion, 9.3 billion, but people are looking past this. Because if we look at total orders for their equipment and services, 1 year ago, about $10 billion worth. Now, almost double that. What do they actually do? Well, that could take 25 minutes to talk about, but simply put, they manufacture devices that generate electricity, one of their biggest products being their advanced gas turbines. So they not only sell equipment to the biggest power producers, private and public, in companies like Vistra, Constellation Energy, Duke Energy, but they also partner with some of the biggest mega cap stocks that exist, like Amazon, to help them electrify and decarbonize data centers. And at this point, you've probably heard that Amazon, along with the other big tech companies, are spending a lot of money on infrastructure for artificial intelligence. That's not only going towards buying chips and other AI stuff, but the power to actually make those chips useful. And they separate themselves with higher margins than some of your other traditional power providers because of their long-term service agreements. If you use our network of electrification, our gas turbines, whatever it is, we'll make sure that they're up as much as possible. We'll optimize grid usage for you. We'll drive down the cost of electricity. That's a high margin business that isn't usually associated with providing electricity. And they're able to generate so much money in high margins and sell so many damn service agreements because approximately a quarter of the world's electricity is generated by their products. And when I say a lot of money, they are literally sold out of production capacity for their big, handsome, heavy-duty turbines until 2028 and likely 2029, 2030. We're talking about a backlog of $163 billion of foreseeable revenue coming. So as you'd expect, people are trying to price that in right now. Is this going to be an Oracle-like situation where you project, $500 billion of future performance obligations, but then people start to realize that, how are they going to get the money to service all that revenue down the road? We'll worry about that at another time. Plus, they usually do really good after earnings. I hope that helps. GE Vernova.